China dumps $688 billion in US debt, buys silver instead. Market panic. 6 months ago. Financial analysts noticed something they couldn't explain. 600 vanished from US Treasury markets, not slowly. And it changes everything about your savings, your retirement, the stability of the currency in your wallet. Beijing didn't just sell American debt, they converted paper promises into something Washington cannot freeze, cannot sanction, cannot control. While Treasury officials slept, the greatest wealth transfer in modern history occurred. And what's coming next? Welcome to Boring Currency Index. Now, before we examine this financial earthquake that is restructuring global markets, a moment of your time. You see that subscribe button? Your generation understood something younger investors often forget. Information before the crowd. That's how you survived every market shift. Your father didn't ignore warning signs in 1987. Your colleagues who saw 2008 coming, they were the ones paying attention to data others dismissed. This channel operates on that same principle. We don't provide entertainment, we provide strategic economic briefings. So hit that subscribe button, not as a favor to us, but as insurance for yourself, and drop a comment below. Tell us where you're watching from. New York, London, Singapore, Mumbai. Because what's happening right now, it's coming to your portfolio regardless of your zip code. Now, let's talk about what China just executed and why your financial advisor isn't telling you about it. The financial world operates on trust, on promises written on paper, on the belief that debts will be honored. For decades, this system worked perfectly. China bought American debt. America spent Chinese money, and the cycle continued until it didn't. In the third quarter of last year, something unprecedented began. Treasury officials in Washington noticed unusual activity in their bond ledgers. China, America's largest foreign creditor, was selling, not the usual market adjustments, not seasonal rebalancing, but systematic liquidation on a scale never seen before. Month after month, billions of dollars in Treasury bonds disappeared from Chinese holdings. By the end of the period, $688 billion had vanished. The analysts were puzzled, the economists confused. The media silent. Everyone asked the same question. Where's the money going? To understand the magnitude of this shift, one must first understand the relationship itself. For over 20 years, China held more American debt than any other nation on earth. They accumulated over $1.3 trillion in Treasury bonds at their peak. This wasn't charity, it was strategy. By buying American debt, China kept the dollar strong and their yuan weak. This made Chinese exports cheaper. American consumers bought more Chinese goods, and the money flowed back to America in the form of Treasury purchases, a perfect circle benefiting both nations. American families enjoyed cheap electronics, affordable clothing, and low interest rates on their mortgages. China built the world's largest manufacturing economy, employed hundreds of millions, and accumulated massive dollar reserves. The system seemed unbreakable, but systems built on imbalance eventually break. The breaking point came quietly, without dramatic announcements, without emergency meetings. It started with observation. Chinese financial strategists watched what happened to Russia in 2022. When geopolitical tensions escalated, Western nations did something unprecedented. They froze Russian dollar reserves, cut Russian banks from the international payment system, and weaponized the very currency that underpinned global trade. Hundreds of billions of dollars held in Western banks became inaccessible overnight. Russia, despite being a major energy exporter, found itself locked out of its own money. The lesson was clear. Dollar reserves are not assets. They are vulnerabilities. Any nation holding large amounts of dollars is exposed to political decisions made in Washington. If America could freeze Russian money, it could freeze anyone's money. Beijing understood this immediately. The strategists began planning. Quietly, methodically, without public announcement. The plan was elegant in its simplicity. Sell the Treasury bonds, take the dollars, and convert them into something that cannot be frozen, cannot be sanctioned, cannot be controlled by any foreign government. Physical gold and physical silver. The data reveals what words cannot hide. As China's Treasury holdings dropped by $688 billion, global gold prices began behaving strangely. Normally, when interest rates rise, gold prices fall. Investors prefer bonds that pay interest over metal that just sits in a vault. But gold wasn't falling, it was rising, month after month. Gold hit new all-time highs, despite the Federal Reserve raising interest rates to levels not seen in decades. Silver followed the same pattern, climbing steadily, defying traditional market logic. The mystery solved itself when analysts connected the dots. China wasn't trading for profit. They were trading for survival. Price didn't matter. Whether gold cost $2,000 per ounce or $2,500 to $1,200 per ounce was irrelevant. The objective was simple: convert vulnerable paper assets into invulnerable physical assets. They were buying insurance, not investments. The scale becomes clearer when one examines China's position as the world's largest gold producer. Every year, Chinese mines extract hundreds of tons of gold from the earth. Not a single ounce is exported. All domestic production, every gram, stays within Chinese borders. On top of this, imports are flowing in, through Hong Kong, through Switzerland, through proxy buyers around the world. Analysts estimate that China's true gold holdings could exceed 30,000 tons, nearly 4 times the official reserves held by the United States. But here's what makes this truly significant. A treasury bond sitting in a computer system can be frozen with a keystroke. A gold bar sitting in a vault in Shanghai cannot. Then there's silver. The world treats silver like gold's forgotten cousin, decorative, secondary, almost an afterthought. China sees it differently. Every solar panel requires silver paste for conductivity, approximately 20 grams per panel. Every electric vehicle uses silver in its electronics, in its charging systems, in its battery management, 5G infrastructure, semiconductors, medical equipment, all dependent on silver's unique properties. No substitute exists. You can replace gold with platinum in some applications. You can use alternative metals in jewelry. But silver's electrical conductivity, its thermal properties, its antibacterial characteristics are irreplaceable in modern technology. And China is building a technology-dependent economy at a scale never before attempted in human history. Did you know China installed more solar capacity last year than the entire US has in its history? They also built 60% of the world as electric vehicles and are dominating industries like semiconductors and 5G. What's the one thing all of these have in common? They all require massive amounts of silver. While Western investors were busy debating if silver is real money or just an industrial metal, China quietly embraced both ideas. The industrial demand secured their manufacturing dominance, while the monetary demand protected their currency from a potential dollar collapse. It's a brilliant two-pronged strategy. The lesson here is simple. Real wealth isn't just digital numbers on a screen. It's physical assets that can't be deleted or devalued by foreign powers. China executed one of the biggest financial swaps in modern history, trading paper promises for humanity's oldest store of value. And we are just now starting to see the consequences unfold. Thanks for watching. There's an old saying among military strategists: amateurs talk about tactics, professionals talk about logistics. While the world watched stock tickers and bond yields, China was playing a different game entirely. They were building a fortress, not with concrete and steel, but with copper and lithium, uranium and rare earths. And at the center of it all, silver. Here's what most analysts missed while obsessing over the treasury dump. The gold purchases were obvious, dramatic, easy to track. But gold was never the full story, it was the headline. While the real operation happened in the footnotes. China wasn't just buying one precious metal, they were cornering entire commodity markets, systematically, silently, for nearly a decade. Start with lithium, the white gold of the battery revolution. China controls 80% of global lithium refining capacity, not because they have the most lithium deposits, but because they bought the mines, the processing facilities, the supply chains, years before the electric vehicle boom began. Bolivia has lithium, Australia has lithium, Chile has lithium. But China has the refineries that turn raw ore into battery-grade material. Control the refining, control the industry, then copper, the backbone of electrification. Every meter of electrical wiring, every motor, every transformer requires copper. China consumes 54% of the world's copper, but they're not just consuming it, they're stockpiling it. Chinese state-owned enterprises purchased copper mines in Peru, Zambia, the Democratic Republic of Congo. When Western mining companies struggled during price downturns, Chinese buyers appeared with cash offers. Now those mines ship directly to Chinese smelters. Uranium follows the same pattern. While Western nations debated nuclear power, China built reactors, 50 nuclear plants currently operating, another 100 planned over the next 15 years. They signed long-term uranium supply contracts with Kazakhstan, Namibia, Niger, locked in prices, secured supply, guaranteed energy independence. And then there are rare earth elements, the hidden ingredient in every advanced technology. 17 obscure elements on the periodic table, essential for smartphones, missile guidance systems, MRI machines, wind turbines. China produces 70% of the world's rare earths, refines 90% of them. The West has rare earth deposits, but refining is toxic, expensive, environmentally destructive. China did the dirty work and now controls the supply chain. Notice the pattern. This isn't random buying. It's systematic resource capture. Every commodity China is hoarding has one thing in common. You cannot fabricate it, you cannot print it, you cannot create it with financial engineering. It exists in fixed quantities, in specific locations. It must be physically extracted from the earth. This is the opposite of the American model. The United States built an economy on services, finance, intellectual property, things that exist on spreadsheets and in legal contracts. China built an economy on things you can drop on your foot. And here's why that matters. In a currency crisis, in a financial system collapse, in a moment when trust evaporates, you cannot eat a treasury bond. You cannot power a city with a credit default swap. You cannot manufacture smartphones with derivatives. But you can do all of those things with copper and silver and lithium and uranium. There's a moment in every financial crisis when the crowd realizes what the insiders knew months ago. By then, it's too late. The exits are crowded, the prices have moved, and the window is closed. That moment is approaching faster than most people realize. The question isn't whether the system is shifting. The data already confirmed that. The question is, what does an individual do when the largest economy in the world is dumping the currency they're paid in, saved in, and retire with? The answer starts with understanding a simple principle. Currency risk precedes all other risks. An investor can pick the perfect stock, analyze the perfect company, time the perfect entry, but if the currency that stock is priced in collapses, the investment collapses with it. This is what happened in Argentina, in Turkey, in Venezuela, in Zimbabwe. People held safe government bonds, blue chip stocks, real estate in major cities, all of it denominated in a currency that evaporated. Their wealth didn't disappear because they made bad investment choices. It disappeared because the measuring stick itself was destroyed. The dollar is approaching that inflection point. Not tomorrow, not next week, but the trajectory is set. When the world's second largest economy systematically exits your debt market, when oil can be purchased without your currency, when central banks globally reduce their dollar reserves, the outcome is mathematically certain. Only the timing remains unknown. So what should a rational person do? First, understand the wealth transfer mechanism. In every currency crisis, wealth doesn't vanish. It transfers. It moves from those holding paper promises to those holding physical assets, from savers in currency to owners of resources. The middle class, holding retirement accounts in bonds and cash, is the target demographic for destruction. Not through malice, but through mathematics. Bonds lose value when interest rates rise and inflation accelerates. Cash loses purchasing power when central banks print to cover government deficits. The middle class in Weimar Germany, in 1920s Hungary, in 1990s Russia, all experienced the same outcome. Their life savings earned through decades of work evaporated in months. Meanwhile, those who owned farmland, gold, productive assets, survived and thrived. The pattern repeats because human nature doesn't change. Governments always choose inflation over default. Printing money is politically easier than admitting insolvency. Second, recognize the institutional rotation beginning. Pension funds, insurance companies, sovereign wealth funds manage trillions of dollars. Most are structured with 60% stocks and 40% bonds. The traditional balanced portfolio. This worked for decades when bonds were safe and stocks grew with the economy. But when your bond holdings lose value because your largest buyer is selling, the math breaks. Pension fund managers are watching the same data. They see China's exit. They see rising yields. They see unrealized losses accumulating. Eventually, they will be forced to rotate. When trillions of dollars attempt to move from bonds into alternative assets, the price impact will be extraordinary. Gold markets, silver markets, commodity markets are tiny compared to bond markets. The entire above-ground gold supply is worth roughly $15 trillion. The global bond market is over $130 trillion. If even 5% of that bond money tries to enter gold, the price doesn't rise linearly, it explodes exponentially. The final principle is psychological. The hardest part isn't identifying the problem, it's acting before social proof validates the decision. Every person wants confirmation, wants others to move first, wants certainty before committing. But certainty in financial markets comes at a price. Certainty means everyone knows, which means everyone is buying, which means prices have already moved. The uncomfortable truth is this: the best financial decisions feel wrong when you make them. They feel early, contrarian, uncomfortable. That discomfort is the price of being right before the crowd. China dumped $688 billion in treasuries. They bought gold and silver and copper and lithium. They did this quietly, systematically, months before the data became public. An individual cannot replicate China's strategy at scale, but they can replicate the logic. Trade depreciating paper for appreciating assets. Move before the institutions move. Position before the panic.